let's get ready to welcome in our first guest, and that is Julian Counihan. And there he is. Julian, welcome to the show.
Thanks for having me, Rob.
Yeah, it's great to have you. I'm doing fantastic, and thanks for joining. So, Julian, I think I described you in my intro as the NG, or new gangster of the supply chain, because I don't think there's anybody that I've met in such a short time that almost everybody I talk to says, hey, do you know Julian Counihan? So you've kind of quickly gained a great reputation in this business. And so maybe I'd like to start with the question. Before we begin with the questions, can you give us, the listeners, sort of your background in general, and then more specifically, how did you get started in supply chain investing?
Sure. So I started as a software developer working on warehouse automation. Did that for a while and left for technology investment banking, spent 5 years there, and I've been investing in venture capital for about 9 years now. So I made supply chain my focus very early on in my venture career. And so I've been working on this for quite a long time, leaning on my background in networks in the category, which led to launching Schematic Fund 1 in January of 2017.
Okay, great. So perfect background. Interesting that you went from coding to investing in technology. For sure, I don't hear that transition too often. So great background. Let me just start with the first question that I've got. So looking back since you began investing when you started Fund 1, what's been the biggest change that you've seen in supply chain technology in the last few years? So when you look at your beginning to now, what kind of changes have you seen over that time?
Well, I would say that capital has radically transformed the supply chain technology category. You're seeing way more venture-backed companies being started in supply chain today than you were when I started investing in 2017. One thing I like to highlight when comparing how far we've come, an event I threw in 2016 had 10 really small companies, including Flex, Convoy, Emerge, Right Hand Robotics, and about 7 of the 10 companies that were present in a small event that I threw in a tiny room at a Hyatt in Chicago are unicorns now. So
wow, amazing.
The category is just much bigger today. You have more investors focused on the area, and you have more companies being started. So 10 years ago, who were starting supply chain technology companies, I would say 100% industry practitioners. Today, you see folks entering the sector from other areas of technology who see opportunities and applications of technology that they've worked on elsewhere and applying that to the industry.
Yeah. Go ahead, John. Sorry.
If I would sum it up, I would just say the industry has been radically transformed and is just so much bigger than it was 10 years ago.
Yeah, and you mentioned capital infusion as being sort of a root cause of that. What do you think is driving investors to increase these investments to the extent you're talking about in supply chain? What do you think is driving that decision to invest in supply chain versus any other industry or versus other industries?
Well, great question. There are a bunch of reasons. I think a lot of the credit comes or should go to some of the first movers in the category, the Flexports, the Convoys, who brought attention to how big and fast you could grow a company in this sector. There was a lot of hesitation initially around the margins when investing into supply chain. And I think investors have subsequently learned that there are a lot of products that can be developed that are SaaS, truly high margin subscription software products in the industry. So I'd say first movers and the massive success they've had. You've also got the growing of supply chain. I mean, supply chain is the backbone of the e-commerce industry. And with catalysts like COVID, it was really brought to the forefront. So a lot of reasons, but today where we're at, I would say every large venture fund has a supply chain thesis, whereas again, 10 years ago, most funds wouldn't even touch the category.
So let's talk about that for a minute. What would you consider to be your thesis? I'd like to learn more about sort of your investment strategy. So what's your thesis? How do you determine where you want to invest? What segments or technology are you most excited about today?
Sure. Well, you're going to love this. Our thesis is we invest in great founders and entrepreneurs, and we're investors in Mercado, obviously. So we've got.
I'm blushing. Thank you.
So we're less thesis driven than I would say the average venture fund. We like to react to, again, great teams. If we meet a great team building a product in a super saturated category, we will still invest into that team. We do not feel that supply chain is a winner take all market and that we need to ride the waves of hype cycles. That being said, there are markets that we're seeing emerge in commercial viability. So last year we made 2 investments in the electrification of fleets, specifically around class 2 through class 6 vehicles that return to a depot every night. For class 8, we're more focused on the applications of hydrogen. So we made 2 investments in the electrification of fleets last year, and we did that because we see a robust commercial market today, but we see the electric fleet market coming into fruition in 4 to 5 years. So we're pre-seed investors. We invest $1 million into teams and ideas at the earliest stages, basically at the moment of company formation. And we're sort of looking at the company being a very large company about 5 years out. So electrification, we think, is still new, but by the time these companies grow into being very large companies, we think the market will be robust and established. Other trends, I would say something that's popped up in the past couple of months, which completely aligns with your comments earlier around the flipping of the supply chain category from demand to supply and the changing of the sort of balance of strength in the equation. So it was all about capacity and assets over the past couple of years. And you're seeing softening in the domestic freight market. You're seeing buildups in inventory. And I think this sort of changes the equation a little bit. So if we're investing in, let's say, domestic freight companies today, we want to invest in technology that will help either the carriers or the brokers be more competitive in a down market. So that's a sort of near-term trend. One trend that I'll add as an investor that I'm watching very closely is the reaction of the venture markets to rising rates. So it has been a just bananas boom market for the past 3 to 5 years. Never a better time to be a founder and never easier to raise large amounts of capital at great prices. With rising rates that we're starting to see this year, there is the possibility that that changes. So when I started in venture in 2014, seed rounds were $1 million, A rounds were 5 million, and those were absolute sort of breakout financings. Last year, I would say the Series A rounds that we saw in the portfolio ranged from 20 to 30 million. So it's possible that with rising rates, the venture market starts to pull back to levels of maybe 3 to 4 years ago. We see round sizes shrink. We see it be more competitive to raise capital. And the focus of investors moving from, okay, I'm going to finance you and we're going to sprint towards the next fundraise, more so to, I'm going to finance you. Let's focus on a longer runway and more business building.
Interesting on a bunch of levels. Julian, I'm going to back a lot of stuff, a lot to unpack there, let's say. You talked about electrification. We had a comment from the audience from Alice Wang, said, interesting topic at that particular moment. Can you talk a little bit more about electrification and what that means to you? I don't know that everybody in the audience necessarily understands that terminology. So
the electrification of fleets to us at Schematic is the adoption of electric vehicles in the, let's say, local delivery markets or regional delivery markets. So this could be a parcel van or a step van that you might see FedEx or UPS use, or it could be a larger box truck that perhaps XPO uses for local big and bulky delivery. So when we look at the electrification of fleets in that particular category, we see a lot of great trends, which we think make electric vehicles viable and both viable and preferable over combustion engine vehicles. So you've got returning to the depot every night, so shared charging infrastructure, and the speed of charging is not a friction point when the vehicles are not being used overnight. You have better emission standards. You have government mandates as far as the percentage of vehicles in your fleet that must be electric by a certain date. California has them, a bunch of states have them. And then finally, you have a push from consumers who want their supply chain partners and their delivery experience to be more sustainable. So all these together, we're seeing fleets really engage and evaluate how they're going to incorporate electric vehicles into their local fleets. And so when we're looking in our crystal ball, we see this market being a robust market in about 4 years. So right now, today, we're investing in really the picks and shovels around that trend.
Is another factor, and maybe this ties into another point that you made in that opening, is another factor labor? There's widely reported driver shortage in the marketplace. Does electrification help at all with that, or is that an unrelated issue? Because now we're talking about autonomous vehicles. Are you looking at that as well?
I have not invested in autonomous vehicles in the public environment because of the exogenous factors that are outside of the company's control. So there's one thesis we have here is if we invest into a great team and they do everything they had planned, but the market does not emerge or evolve and that demand never appears, that's just not, or if there's a factor that's outside their control that determines the fate of the company, that is less of our strategy here. So with investing into autonomous public vehicles, you've got government regulations around safety. Even if the vehicle is doing great, when it is certified to carry serious freight on the open road, you've got labor issues. I mean, 3 million drivers in the United States carry the domestic freight, sort of power that environment. So are you going to replace that? How will those unions react? And the constituents of various politicians react. So for all those exogenous factors, we haven't invested in autonomous vehicles in the public environment. It could be that we're absolutely wrong and it turns out to be a gangbuster environment for the Class 8s. But we have invested in autonomous vehicles, but in the private environment. So where a lot of these exogenous factors don't exist. So we've invested in one company. It's called Outrider. It's an autonomous terminal truck that moves containers in yards. And in that particular environment, you can control all the factors that I mentioned might slow down the adoption of public autonomous vehicles.
Interesting. All right. Thanks for that perspective. And then, so I want to go back to something else you said where you talked about the gangbuster investments had largely been focused around capacity in that supply environment or demand environment, and in the supply, more about efficiency. Do you have any sort of additional thoughts on the type of investments you would make for efficiency versus for capacity? Can you give an example of that?
Well, if you're a carrier in a down market, you're very focused on the assets that you own and high utilization and maintenance. So both the efficiency, utilization of the asset and the performance of that asset, the lifetime. So looking at the maintenance environment, we think it's a great environment. And then we're looking at technology that ties volume to that capacity. So as a carrier, how can you enter into guaranteed contracts that will provide guaranteed utilization of your asset throughout the year? So one great company to highlight here is Leaf Logistics. So Leaf with financial contracts will give you the ability to lock in volume that meets the needs of your carrier fleet. So that's a great example of how we would invest into domestic freight around a down market. So maintenance and performance of the asset, and then locking in and guaranteeing utilization of that asset.
Julian, does your fund or your firm, I should say, think about the overall industry? You know, one of the things that I have observed over my time in this industry is just the general resistance to technology. As you know, probably better than anybody, it's been an industry that's relied for a long time on sort of traditional tools like Excel and email. Do you see that as a barrier to growth, or do you see that that's changing in the external marketplace and more customers are recognizing, maybe through this crisis or maybe otherwise, that technology is going to be a component?
I definitely think that's changing. And I think it's changing because of the generational shift that you're seeing in the supply chain industry. Folks with P&L control, buyers today, are in their 30s and 40s, and they grew up with an iPhone. So they are starting to expect that high-end consumer UX UI in the products that they buy today. And I think they're better buyers as well. Less stakes in Topgolf, although that's always going to be part of the supply chain industry. But perhaps less stakes in Topgolf and more SaaS software, more online cloud purchase of. I mean, when I started investing in this category, there was still a hesitance around cloud software inside the warehouse, and I think that mindset is today in 2022 almost completely gone. The idea of buying on-prem software is, it's not something I've heard of recently.
Okay, great. And so, just a quick note: I'm going to short my stake in Topgolf stocks.
I love Topgolf.
Yeah, I do too. Just real quick, Joe, I want to give a shout out to Samuel Escala Osa. He's tuning in all the way from Panama. So shout out to Samuel. I've got a question here, Julian, for you from Sarah Barnes Humphrey. She's talking about predictive capacity on international freight rather than quoting then finding capacity would be a game changer. So do you think at all about some of the technologies that we've seen emerge that are using, call it machine learning and then artificial intelligence to be more thoughtful, because they've got all the computer capacity, about predicting where capacity will be available? Is that something you get involved with?
Well, from an international perspective, I would say the liners are very good at their business, very sophisticated companies. So when they're predicting macroeconomic events that will change volume and trade lanes, I would say they're pretty good at that. I would say for a retailer or SMB, the idea of predicting upstream capacity or changes in trade partners, there's sort of a step before that. I don't think we're at predictive yet. I don't think we have the data or connectivity where predictive makes sense. I think, and this is something great that Mercado is working on, is connectivity is the first step to. Do you want to take that?
Just my alarm. Let me know. This time flew by. No, sorry, Julian. This time flew by. I wasn't even paying attention to the clock. So please.
So I think, it's companies like Mercado that are creating the connections which are necessary as the foundation to then apply predictivity. And, predictivity in domestic supply chain categories, absolutely crucial. Got a lot of companies working on this. Cognops is applying that inside the warehouse. But when it comes to international, I think first you just need that foundation of connectivity. And that's companies like Mercado that are connecting upstream partners with domestic partners. And it's first that piping before you can get into the sophisticated, let's forecast the future.
Okay, I've got one more for you, Julian. We've run a bit over, but Jay Harmon said, digitization is the future of supply chain space. I guess his question is, do you agree, Julian, and does the audience agree? Any doubt in your mind, Julian, that digitization is the way we're going to go forward?
I guess if I didn't agree, I would be saying that paper and pencil.
And you get out of the supply chain tech investing business on top of it, yeah.
So I think I obviously agree. Digitization is the future. The one twist I'll put on that is sometimes it seems obvious that digitization is the future. And you brought up the reliance on Excel and sort of more rudimentary tools. But the friction that you see, no one today doesn't want software. They just want the right software. They don't want too much software, and they want full connectivity. So if you see any hesitation around software adoption, usually it's not because anyone doesn't like software. It's because of the burdens about purchasing the wrong software do exist and are well known.
Sure.
So, yep, we're pretty much all in on digitization.
Pro digitization, yeah. And let's just hope everybody gets online. Managing it with 1985 technology is not the way to go. So, right. Julian, thank you very much for your time. As always, I enjoyed it. And again, sorry for the alarm. It flew by. I didn't even catch it. But I hope you have a great afternoon, and thanks for joining.
Great. Thanks, Rob. Thank you, everyone, for tuning in.